Most people believe taxes work on a simple principle. The more money you make, the more you pay. That's how it feels when your paycheck gets hit every month. But at the very top of the wealth ladder, that rule quietly breaks down. In fact, the richest individuals in America often pay far less, sometimes nothing at all, while their wealth explodes by billions. Between 2014 and 2018, Jeff Bezos saw his net worth grow by roughly $99 billion. Over that same period, his total federal income tax bill amounted to under $100 million. That sounds large until you compare it to the wealth increase. Do the math, and the percentage comes out to well under 1%. Meanwhile, someone earning $60,000 a year typically loses 10 to 12% of their income to federal taxes alone. The person making billions paid a fraction of what an average worker pays. And Bezos isn't an outlier. In certain years, some of the wealthiest people on Earth legally paid zero federal income tax, despite being worth tens of billions. Not because of fraud, not because of hidden offshore accounts, but because the system itself allows it. This outcome comes from a structure that rewards ownership over income and patience over productivity. It's a system built around assets, leverage, and timing, and it operates entirely within the law. The foundation is simple. Wealth grows differently than income. When you work for money, the IRS taxes it immediately. When money grows on its own through assets like stocks, real estate, or private companies, that growth isn't taxed unless it's realized. If an asset doubles in value but isn't sold, the tax bill is zero. For most people, that delay is temporary. You eventually sell investments to pay for a home, retirement, education, or emergencies. When you sell, taxes apply. But the ultra-wealthy don't need to sell. They structure their lives so they never have to. Instead of turning assets into cash, they turn assets into collateral. Massive portfolios of stock or property are pledged to banks in exchange for loans. The bank doesn't care because the collateral is enormous, and often appreciating faster than the loan's interest. These loans come with interest rates far lower than what ordinary borrowers ever see. Here's the key detail. Loan proceeds are not considered income. Borrowing money does not trigger income tax. So when a billionaire takes hundreds of millions in loans to fund their lifestyle, the IRS treats it as not taxable. No paycheck. No realized gain. No tax. As long as the assets continue rising faster than the interest cost, the borrower gets richer while living on borrowed money. The loans can be refinanced, extended, or replaced with new loans indefinitely. From the outside, it looks like unlimited spending. From a tax perspective, it looks like almost nothing happened. Banks love this arrangement. The loans are safe, highly collateralized, and generate steady interest. The borrower keeps control of their assets, and the tax system collects very little. Then comes the final step, which locks the entire structure into place. When assets are passed on after death, the tax code resets their value to current market prices. Decades of appreciation effectively disappear for tax purposes. Gains that were never taxed during life are erased at death. The heirs inherit the assets as if they were purchased at today's price, not the original one. That means any sale afterward triggers little or no capital gains tax. Loans taken out during life can be repaid by selling a small portion of assets with minimal tax impact. Or the heirs can simply borrow again and continue the cycle. The result is extraordinary. A lifetime of wealth growth with minimal taxation, followed by a transfer to the next generation where the accumulated gains vanish from the tax ledger entirely. This didn't happen by accident. The rules that make this possible have existed for more than a century and have survived repeated attempts at reform. They've been defended by powerful interests, financial institutions, real estate groups, investment firms because the system benefits them enormously. Any proposal to change it is met with claims of economic catastrophe, that taxing unrealized gains would destroy markets, that families would be forced to sell businesses, that investment would collapse. These arguments resurface every time reform is suggested, and they almost always succeed. Meanwhile, the revenue impact is massive. Trillions of dollars in wealth sit untaxed because they exist as unrealized gains. Studies estimate that tens of billions in federal revenue disappear every year through this mechanism alone. Over a decade, that adds up to hundreds of billions money that could fund infrastructure, healthcare, education, or debt reduction. What makes this especially striking is that the system is inaccessible to almost everyone else. You can't borrow cheaply against modest assets. Small investors face higher interest rates, margin calls, and strict limits. Home equity loans and early retirement withdrawals come with penalties and taxes. The advantages only activate at extreme levels of wealth. So while the tax code technically treats everyone the same, the outcomes are wildly different. The more wealth you have, the more flexibility you gain. The less you earn through wages, the less you're taxed. And once wealth reaches a certain scale, taxes become optional in practice. This creates a paradox. The government relies heavily on income and payroll taxes, taxes that fall hardest on people who work for a living. Capital-based wealth, which dominates at the top, largely escapes that burden. The result is a system where economic contribution and tax contribution drift further apart every year. When people hear that the richest Americans pay a large share of total income taxes, it sounds reassuring. But income taxes are only one piece of the puzzle. Payroll taxes, sales taxes, and property taxes consume a larger share of middle-class income. While capital gains and borrowing remain lightly touched, the structure isn't broken. It's functioning exactly as written. And it continues, because it's complex, invisible, and difficult to explain in a soundbite. Most people never see it. They just feel the pressure of taxes rising while public finances deteriorate. Understanding this system isn't about resentment or punishment. It is about recognizing that the rules governing wealth and work are fundamentally different. And that difference compounds over time. Once you see it, you realize why deficits grow, why inequality accelerates, and why reform is so difficult. The architecture of the system protects those at the top while convincing everyone else that the burden is shared. And unless the rules change, it will continue exactly the same way.